Well, good afternoon, everybody. Happy New Year, 2020. It is amazing that I am actually saying that right now. Another decade, new year. So glad that you guys have decided to join us for our webinar today. And we're going to be talking about something that we think is really important. We're going to be talking about planning for taxes and retirement. Understand, we're going to say with a disclaimer that Ryan and I are not CPAs, but we do know enough to help point our clients in the right direction as it pertains to financial planning. So we want to say welcome. Ryan will be joining here. Ryan Fleming will be joining here in a second. And so we're just really excited that you guys have decided to join us today. The way we're going to start, and many of you have seen this and have been asked these questions, we want to start off with what we think are four not only important but imperative questions when you are doing retirement planning. And this is really important at any stage of life that you are in. If you are in your 20s, 30s, or whether you're in your 60s and you're getting ready to plan specifically to retire in the next few years. These are the four questions we want to ask you. Number one, what rate of return do you have to earn on the assets that you have accumulated for you to live at your current standard of living and last until life expectancy? That is why many of us invest, because we want to gain more than what a cash account is going to provide. And so we need to understand, if you're going to either invest or save at a certain level, you want to have some sort of benchmark anticipation of what amount that is going to grow for you so that you can plan for retirement. Really important to understand, as you're putting your money in a certain environment, that you have realistic expectations of what that is going to do for you. Number two, we want to ask, how much do you need to have saved today for you to live at your current standard of living and last until life expectancy? Now, what we have found, as we have worked with a number of people over the years, this can be a matter in which people do not have realistic expectations. And so one of the things when we are working with our clients and working with individuals and couples that we help teach them, you have to save at this level in order for you to reach your financial goals and objectives. Number three, if you are not yet retired, you know how long you will have to have worked or how long you will have to work for you to live at your current standard of living and last until life expectancy. That is always the big question that people want to ask. How long do I have to work? Or some of you that are very ambitious that want to retire early, maybe in your mid to late 50s, you're going to have to make sure that you understand that and have a realistic picture so that you can plan accordingly. And then lastly, we want to ask, if you do not do anything different than you are doing today, how much will you have to reduce your standard of living for your money to last until life expectancy? And so we feel that those four questions are imperative, that you want to make sure that you understand those so that you can plan accordingly. Okay, and we're going to talk specifically understanding how the tax environment is going to have an impact on that. You see now in front of you what we call the personal economic model, and many of you have seen this. We've gone through this personal economic model with you. We're not going to go into detail that we have with some of you individually, but we feel that having this picture in front of you is really helpful as it pertains to how retirement works. Now, this is not profound, this is not overly complicated, but we feel that this picture is going to speak to you in a way that's going to have an impact on what you need to do long term. So most of you that are joining us today, you have some sort of job or income that you're making, and money starts at the top and goes into this left tank. This is the largest of all the tanks. And this is what's called your lifetime capital potential. This is the largest of the tanks because many people don't, there is a finite amount, but many people don't or aren't aware of the amount of lifetime capital that they can make over the course of their life. So money's going to come into this tank. It's going to go down, and the first stop that you are going to see is the tax filter. Now, this is unfortunately a filter that you're not going to be able to, at least legally, you're not going to be able to avoid. And so how you get past this filter and the manner in which you approach this filter is what we're going to talk about today, because we feel that you can maximize not only short-term and long-term, but it's going to help you get past this filter in a way that's going to prepare you and set you up for the most amount of success. After you pass that tax filter, you now come to what's called the Lifestyle Regulator. And so now you have a decision of, once you pass taxes initially, what you're going to do with the income that you brought in. Obviously, the higher that your lifestyle is, the lower amount your future lifestyle is going to be, and vice versa. So if you can lower that current lifestyle, that gives you the opportunity to save more for your future lifestyle. Now, I like the way that this picture is set up because it's showing an uphill push to get those funds into these two tanks. And these two tanks are what's going to set you up for your future lifestyle. You have the right side, which is your savings or your safe tank, and then you have your investments tank on the left. One of the things that I want to call out specifically is if I were to look at most people that are joining us today, and I would look at your overall assets, I would say it's probably safe to say that 80 to 90% of the total assets that you have is probably in the form of a qualified plan, either a 401k or a 403b, depending on who your employer is, which is going to directly fund this investment or this risk tank. Most of the money you're going to fill from that is because maybe you get some sort of match from your employer. Most of the time that's directed so you don't even have to touch it, and a lot of times that's on autopilot. What most people don't realize, though, is what they're investing in. They don't realize how much they're investing, and they don't realize why they're investing. They may have heard something, put as much from your incoming source of income, and just automatically put as much into that risk tank or that investment tank from your qualified plan. So after you are done working, and I think this picture says it all, is that income tank or that income potential tank goes away, and now you have to utilize your current lifestyle based on what you were able to save in these two tanks. Okay? And so what we want to do is now talk about, once you are in this environment, or how to prepare for this environment, some efficient ways to do that. And I'm going to introduce Ryan now. Ryan Fleming is going to talk about how qualified plans work and the impact of the taxes on those qualified plans, both short-term and long-term. So Ryan, thank you for helping us out today, and we look forward to hearing what you have to say about how these plans work.
Brian, fantastic. Very, very good job. Happy New Year, everybody. Brian just really hit upon, in a very short amount of time, a very profound discussion we like to have with our clients. And that personal economic model is just so important to understanding what you're doing now and in the future. So like Brian said, one of the things that's so prevalent in our culture is this notion of qualified plans. And as you can see right here, there's a lot of different types of qualified plans. An easy way to maybe think of this is if you replace the word retirement in for qualified, and it read retirement plans. These are typically things that we know: 401ks, IRAs, 403bs, those types of things. And so I'm going to spend some time on that. And the first thing we got to do is just understand that qualified plans do two things. I'm giving you the answer to the first thing that they do, and it's defer the tax. But what a lot of people don't know is that they also defer the tax calculation. Now, a word that Brian and I like to use other than the word defer, which we think is more appropriate, would be the word postpone. You know, it would be nice to know when you enter into your 401k, if the verbiage on the paperwork said, this is a retirement postponement plan that you're contributing to. The government's not saying that you don't owe the tax. They're just saying that you have to pay it at a later date. So here's a quick analogy. Let's say that you're in need of some money and you need $20,000, and I was more than willing to lend you $20,000. Probably the first two questions you would ask me is, Ryan, what interest rate are you going to charge me to use this money, and when do I need to pay you back? Those would be very smart, wise questions to ask me. And if my rebuttal back to you was, you know what, I don't need the money right now, but when I'm about 70 and I'm getting ready to retire, I'll need the money then, and at that time, I'll go ahead and calculate all the interest and the fees and things that I need, and then I'll let you know at that time. And the question would be is, if that was my answer, would you cash that check? And I don't think anybody on this call would answer yes. But the reality is that is exactly the relationship that you and I enter into when we decide to put money into qualified retirement plans, i.e. 401ks or 403bs, IRAs, etc. So that's interesting. The two questions that we need to ask our clients and that you need to be asking yourself is, well, what tax bracket will I be in at retirement? And the second question is what deductions will you have when you take the money? Based on how you answer these questions is going to help you determine what's the best tax strategy for you. Should you save pre-tax or after tax? Now, in many cases, there's no way humanly possible that we can absolutely prove taxes in your bracket are going to be higher or lower in retirement, or prove what deductions you'll have. But what we have to do as rational human thinking adults is we have to follow the evidence. And I want to give you just a little bit of evidence right here for you to consider today. This has to do with the notion of tax thresholds. Now, to make it a little easier for us, I want you just to focus like in the middle of the screen on the year 1941. In 1941, if you were in the lowest tax bracket, you paid 10%. And in order to qualify for the lowest tax bracket, you had to make $2,000 of income. 81% was the highest tax bracket that year. And then anybody that made $5 million or more of income had to pay 81% tax on that overage. Now, about 6 months into this year, there was some turmoil, and our country, had to come up with some capital, and there was war and all that good stuff. And so within less than a 12-month period, look at what our federal government did to these so-called thresholds. Well, what they did is they raised taxes 9% on the poor, which is an astronomical spike with such low income. Conversely, they also raised taxes on the wealthy 7%, but what they figured out, and what is so disconcerting, is that they completely redefined the definition of who was rich in our country. And they defined it at such a divergence that I often joke that they cast the largest tax net in the history of our nation at this particular time in our country. So all of a sudden, you went from 5 million being the richest of the rich in our country to the definition in the government's eyes to 200,000. And the reason why I want to show you this is what if you believe in your mind that you're going to retire in a lower tax bracket, or make less money? But at that time, the government redefines that lower tax bracket that you are living in now to be the absolute definition of the richest of the rich. You have absolutely no control, and that's something to ponder relative to your tax strategy. So let's go here. Qualified plans postpone the tax, as we've learned, and they postpone this tax calculation. That's exactly what I just showed you. They postpone the tax calculation, and that's called a threshold. So let's say that we put $10,000 into a 401k plan, and your current tax bracket today is 24%. And when you retire 30 years from now, your tax bracket is going to be the exact same. And during that 30-year time frame, let's say that you've earned an investment return of 5%. Well, if you look, 30 years from now, your account is going to be $697,000 and some change. But the thing that we need to remember is you're entering into a relationship with a person called Uncle Sam, and not all that money is yours. In this particular case, $167,000 and some change is going to be the government's, and you're left with $530,000. Now, if you look down at the bottom, the apparent deferral on taxes over that 30 years has been $72,000. But if you add interest to that, it's actually quite a lot more. And so what if taxes in the future are actually quite a lot higher and redefined? And we're going to take a look at this in the future so you can kind of review the evidence and make the best call for you. But in this case, let's say tax brackets go up to 40% when you retire. Well, naturally, you can see that because of that, and because of no control of your own, the government has quite a lot bigger share of your overall 401k. So the question here is do you believe taxes and tax thresholds will be higher or lower in the future? If they remain the same, not all that money is yours. If they go higher, quite a lot of money is going to be yours. Very few people I've ever talked to feel that taxes are going to be lower in the future. If they are, that's a whole other story. Maybe you should defer the tax. Well, moving on. This is an example of somebody that worked at a job, let's say for a 30-year period. You know, for decades, people would go to college, they would get out, and that degree would land them a job, and that company would train them. They'd work there for 25, 35 years, and they would graduate and earn a pension the rest of their life. Pensions are going away very quickly, and Social Security has its its druthers as far as like sustainability or things like that. But let's just say this is you, and you work at a company for 30 years. Now, when you go to a company, I'm going to break it into 3 10-year time frames. And let's say the first 10 years, you're right out of college, and you were in a lower tax bracket. You weren't a manager, you weren't the CEO, so you're going to be in a smaller tax bracket. And then you got better at what you did, and you moved up a tax bracket, and maybe you're in the 25th% tax bracket. And then when you get to the end of this, maybe you are the president, maybe you're in management, and you're in a much higher tax bracket. And so this is the journey of your career. Now, during this time, let's say, like so many people, they heard that it was a really good idea to put money into your 401k. In this particular case, let's say you put in $10,000 every single year, and the company did not match anything, and you earned a 5% rate of return. Well, what we can quickly calculate is that during your 30-year time frame, the average rate of return in your 401k would have been 4%. Well, many of you work at companies that do offer a match. Some of you have a dollar-for-dollar match, and some of you have a small percentage match. In this case, let's say you put in 10% of your pay, and say you made $100,000 a year, and you put in 10%. Thus, you're saving $10,000 a year. And the company matched the first 3% dollar for dollar, and then that was it. So in this case, they had a $3,000 match. Now, with that match, how did that affect your overall rate of return? Let's take a look. Wow, that actually jumped it up quite a lot. It jumped it up almost another 1.5%, which can be very profound over time. So that was a positive thing. Some of you actually contribute right up to the match. So some companies are very gracious enough to say, if you put in $10,000, we'll match $10,000, or whatever the number is, 100% dollar for dollar match. Let's take a look at how that affects the rate of return. Wow, very, very big jump right there. So it's very easy to see that if you put in something with no match, you get you get an average rate of return. If the company matches, that return goes up. And if you put up to the match dollar for dollar, that's a pretty robust rate of return over a 30-year time frame. But what some people do is they say, well, the company matches 3%, and my CPA or my coworker or my brother-in-law said that I should do everything possible to max out my 401k, $19,000 or $19,500 or the catch-up amount. You're maxing it out in this example. So let's see what happens to the rate of return when you max out your 401k and take the match. And as you can see down at the bottom, the rate of return is astonishingly a lot lower. It's 4.8. So here is the moral of the story. Anything up to the match, in this case, let's say they match 3,000 and you put in 3,000, you can see that that has a huge difference in the overall rate of return. Anything above and beyond the match, I'll do it again, your rate of return is dramatically affected, and all you're essentially doing is just deferring tax. So if the evidence shows and bears out in your heart that taxes and tax thresholds in the future have the propensity to be higher, then perhaps contributing just to the match and not a dollar more may put you in a better position long term. Something to consider, but I wanted to throw some math and analytics your way. Now, this is a conceptual picture. This, folks, is the actual history of income taxation in our country. And if you notice, there was never an income tax levied on our income until 1913. So for many years, you made income and the government kept their hands out of the cookie jar. Ironically, in 1913, another thing that's pretty profound in our culture was created and launched, if you will, which is the Federal Reserve System. The people that have printed money out of thin air, bailed out banks and, other entities in our country and continue to do so today. Kind of ironic. There's a good book about that called The Creature from Jekyll Island. It chronicles the beginning of the Federal Reserve System. Here's kind of what I want to point out to you guys. If you look at the average top tax bracket since the history of income taxes were levied, you can see that it's 57.31%. If you go all the way over here to the right-hand side, you can see that today, I know that might be a little small for you guys, but you can see in that little white box that the top richest tax bracket is 37%. And you have to make $622 some $1,000 to be taxed in that bracket. And what's ironic is that if you look throughout history, you can see that right around here is when Ronald Reagan took office, and for many, many, many years, our country has been riding well under the national average for the top tax bracket. So maybe your investment advisor, or maybe people that are near and dear to your heart say that you should max out your 401k because it's going to just give you such a better chance for a rate of return. The stock market always goes up, and maybe that's what you do. And maybe your account balance in your 401k is $1 million when you retire. Well, if you stay at the same tax bracket that you are now, let's say you're in the 32% tax bracket right now, you can see that not all that $1 million is yours. Or if tax brackets continue to merge closer towards the mean top tax brackets that we've seen over time, then basically here's our proof that we're in a partnership, and the partnership offers you and I absolutely no control. So, wow, when you look at the history of income taxes, what does our instincts tell us? Nobody can prove it. We're not here to say for certain that taxes are going to be a lot higher, but the evidence bears out that perhaps maybe having some after-tax strategies, or in other words, paying tax on the seed and pulling the harvest out, could be a good addition to some of the other pre-tax strategies that you have. Well, relative to that, in our culture, a hot topic are these accounts called Roth IRAs, or even some of you have the option to do a Roth 401k. Brian and I would actually agree that those are really cool options to consider if you think taxes are going to be higher in the future. So how do traditional qualified plans compare to Roth qualified plans? Let's keep the math easy and say, well, what if you just put $10,000 into a 401k pre-tax, or you put $10,000 into a Roth 401k post-tax? Let's say that you were in the 24% tax bracket now, 30 years goes by, and you are lucky enough to remain in the same tax bracket, and you earned a 5% rate of return. And what you can see very clearly is that if you maintain the same tax bracket that you're in right now, there will be absolutely no difference of your net withdrawal, whether you postpone the tax now or pay the tax now, for the ability to pull it out tax-free at the end. On the first side right here, you can see that your account grows to almost $700,000, but here's our partnership again. Uncle Sam takes his, and we're left with $530,000. If we paid tax now, we only put in $7,600 a year instead of $10,000. That's the after-tax number. And our account would grow at 5% to the exact same number, $530,000. The difference is we don't have to pay any tax at the end of the harvest. And at the end of the day, we have a net withdrawal that's the exact same. Now, what I would submit to you, and I know Brian talks about this a lot to his clients, one of the advantages in this particular case, even if it comes out the same at the end, would be you have more flexibility and access to capital for life events by doing the Roth, because you can withdraw your cost basis tax-free while you're living. So another way to put it is that if you want less restrictions on how and when you can take your money, after-tax strategies can provide more access to liquidity, more use and control of your funds. But in this particular case, that's interesting. Well, if we believe that there's no way that taxes are going to be able to go way further down than where they are now, and 30 years from now, we quite possibly could be in a higher tax bracket, well, you guys are smart. You can see what happens. And the math is undeniable. If this is what's going to happen in the future, then your best strategy would be to pay your tax on the seed now and pull the harvest out tax-free. In this particular scenario, you're able to pull out about $110,000 more by choosing your tax strategy now. Again, please, we're not here to give tax advice. We can never prove what taxes and thresholds will be in the future. You have to follow the evidence and decide where you're going to put your faith in. What we see, though, is that 80, 90, sometimes 100% of everybody's savings mechanisms are pre-tax. And that quite possibly could be hindering you with, more wealth in the future.
Great information, Ryan. Man, thanks for sharing that. And numbers don't lie. So wanted to basically close this by, when you're looking at all this information, you go back to those 4 questions and trying to figure that out, and then you process all the information that Ryan just went through with you. Now we have to ask, what are the most important questions to ask as you're determining what is the best strategy, and as it pertains to how taxes work specifically in qualified plans. So the first thing we want to ask is what tax bracket are you going to be in at retirement? We hear a lot of people say that, I'm going to be in a lower tax bracket. More than likely, I can pay the taxes later because I'm going to be in a lower tax bracket and I'm going to need less income when I retire. The theory behind that is the kids are out of the house. A lot of people are going to have their plan to have their house paid off. But statistics will show, when you look at the data and you look at the research, it actually shows that most people need 85 to 100% of their pre-retirement income in retirement. And a lot of people don't quite understand that, and a lot of people don't realize that, but statistics actually show that. Well, here's why. Number one, when you are retired, the one thing that you have now that you didn't have when you were working is you have time. A lot of people want to travel. A lot of people have grandkids that they want to see. A lot of times those grandkids aren't living in the same location that they are in, so they have to travel in order to see their families, right? Number two, and this is the biggest unknown, is what medical is going to do and what your health is going to look like. We don't know what Medicare is going to look like in the future, but in addition, there's other costs that you're going to have to absorb when you are in retirement. And so what tax bracket you're going to be in retirement, what we want to just really encourage you is not to just assume that you're going to be in a lower tax environment or a lower tax bracket. Ryan showed you the chart of taxes. And again, we have asked many people, where do you think taxes are going to go? And it's almost 100% of people will say, well, taxes are going to go up. So we don't have a crystal ball. We don't know what those tax brackets are going to be like. But if you are in the camp where the majority of people that we talk to are, and they think the taxes are going to go up, then I would say it's not safe to assume you're going to be in a lower tax bracket. So that's the first question you got to ask when you're looking at the strategy that you want to pick, is what tax bracket are you going to be in retirement? That should help you determine what type of strategy and environment you want to put your retirement dollars. Next question we want to ask is, what deductions will you have when you take the money? What we find a lot of times is you enter into retirement, you don't have as many deductions as you had when you are working, whether it's children that you can use for deductions, or whether that would be your house, and if your house is paid off, you don't have those same deductions. Understanding that realistically, you're probably going to have less deductions the older that you get. And so that's really important when you're looking at from a tax perspective. A lot of people, when they go into their strategies in their current day-to-day, they look at, well, hey, I have some taxes, I can get some deductions, and that will help offset some things. Understand, as you get older, some of those deductions might not be there. And then finally, what is your exit strategy? So when you look at those 4 questions that we talked about before, And a lot of people, when you ask those 4 questions, they're doing a mental inventory of the assets that they have, trying to understand, okay, where am I at right now? Am I on pace? Am I going to be okay at the time of retirement? And when we meet with our clients and they do the same mental inventory, a lot of times they'll look at their 401k or their IRAs and their qualified plan, and they think that's the amount of money that I have. And the point of this exercise today was to say that is not all of your money. So when we went back to the 4 questions and we said, what rate of return do you need? How long do you have to work? What lifestyle do you want to have? And you answer those 4 questions. Well, we can go through that exercise relatively quickly, but a lot of times we don't necessarily put in the taxes. And so it's really important when you are determining what strategy to understand how much of that money is going to actually be yours. Now, what is your exit strategy? There's a couple different things. What if we said, because many of you that are following us today have most of your assets in 401ks and IRAs. That is pretty typical. And so the question is, do you want to continue not only to fund that way, and we're not saying all of that is bad. We do think it's important if you do get a company match on your 401k to invest up to the match. But what if you have those dollars now and you're doing above and beyond? Is it appropriate to maybe change strategies? What if you are close to retirement and you're thinking, man, Brian and Ryan, I'm not really in a position to change because I'm not that far from retirement, but are there ways that you can take the pre-tax environment and convert those into post-tax dollars, especially as you looked at that chart and you understand now that we're in the lowest tax bracket possible? Are there ways that you can change the strategy or even change the environment to create, 1, a potential less tax burden on yourself later, and maybe number 2, more flexibility? Those are things that we would actually love to talk to you about. So if you would love to schedule a time, we would love to talk to you. You can contact Rose. You see her phone number. You see her email there. Reach out to her. We love the opportunity to speak with you. And so we thank you so much for your time today. We look forward to continue doing these type of webinars throughout the year, and just be ready to get our next invite. We look forward to talking to you, be with you. Happy New Year to everybody, and we wish you well. Have a great day.